All right, welcome back to the most exciting course at Harding University. I'm kind of tired today, worn out with everything. Life has just worn me down. So we're going to finish chapter 1 today. How about that? And I'm going to let you go and enjoy the free day. Can y'all deal with that? Can you dig it? All right. Okay. So moving on, slide 11, not 12, I'm sorry. So the banking industry's largest customers, people who require the services of the banking industry, have found ways to circumvent banks to obtain funds they need. Remember, banks, the main job of a bank is to loan money. Loan money. Are they the only source of funds that borrowers have? Okay? And the answer is no. One way they accomplish this is by borrowing directly from a limited number of institutional investors. Okay? So who are institutional investors? Typically, it's insurance companies. Institutional means business, and they're large organizations and large pools of funds, like insurance companies. Okay? Insurance companies take in premiums. They have gobs of cash that needs to be invested. Okay? And insurance companies loan money. Pension funds. Okay? Mutual funds. These groups attract a huge inflow of money, and that money needs to earn a return. And one way they can earn a return, the way they all earn a return is to invest. Now they can invest in stocks and bonds, but they can also invest in loans. A loan is an investment. Okay, so some borrowers can go directly to investors. This is called disintermediation. Banks are intermediators. They attract funds and then they loan funds. But if a borrower goes around a bank and goes directly to a pension fund that has a need to invest money, that's called disintermediation. Okay? All right, so these loans are called private placements. Borrowing money directly from institutional pools of money. Okay? So typically, investment banks, that's one of the jobs of investment banks, is to locate institutional investment dollars, okay, like insurance companies or pension funds. Who has money that needs to be invested, and who needs the money? It's always bringing together the suppliers of capital with the users of capital. Okay? So often you get investment banks that structure loans that are good for the borrowers and good for the investors. You always have to balance both sides. You can't mess over one side. It's got to be a deal that's good for investors and good for the borrowers. All right. Another way that borrowers can circumvent banks is by issuing bonds. What is a bond? It's a loan. Okay? The bond is a loan. It's an IOU. Okay? Once again, you have borrowers, these organizations that need money, and they go directly to the lenders as opposed to the banks. They go directly to the lenders. Okay? And often individual investors and institutions will buy these bonds. So bonds include individual investors as well as institutional investors. Now, if you structure a bond and you sell it all to one institution or two institutions, it's a private placement. But if you want individual investors to access the bonds, then they're publicly traded and they're not private placements. All right. So, what companies are out there competing directly with banks? And again, this is a bit of a repeat. I've taken a couple of names off because they're really not competitors for a bank. For example, I took fringe banks off. Those are payday lenders and pawn shops and rent-to-own. Why did I take them off? They're not competing with banks. Why not? Because the people who go to these fringe banks, they can't get a loan at a bank. So they're not competing with banks, but they were listed, okay? All right, money market funds. Money market funds are mutual funds that invest in short-term securities, and people they park their money there instead of parking their money at a bank. And banks offer their own types of money market funds. But there are mutual funds out there that are attracting funds, okay? Now, back in the day when you could actually earn a rate of return on short-term assets, you'd attract billions of dollars in money market funds, and the money market fund might pay 2 or 3%. Now they're paying 1/10%, okay? And so why did mutual funds offer them? Because they were charging a fee. They were charging a fee on them, okay? Maybe 1/4 of a point. And you're going, well, 1/4 of a point is really low. Not when you're managing $50 billion, it's not. That's a lot of money, okay? It's a low fee. But you can't charge 1/4 of a point when you're only yielding 1/10 of a point. It's tough, man. We need interest rates to rise some. We do. All right. Mutual fund companies, people are placing cash there. And hedge funds, they're making loans. Hedge funds are investing in loans. Okay. Security brokers and dealers, they're competing with banks. They're making loans. Okay. It's really kind of, I lump them in with investment banks. The functions are a little bit different, but both groups are offering the same services that banks offer. And a lot of times now, these groups are part of commercial banks. They used to be separate, but now they have banking charters. We used to have a large number of security dealers and investment banks, and after 2008, we lost 2/3 of them, and they rolled into being owned by banks, commercial banks. All right, finance companies. Finance companies. Finance companies do not take in deposits, but they make loans. Okay? So you go to buy a car, and you might decide to have Ford Finance Company finance that Explorer that you're buying. That's a finance company. They're not a bank. They don't have deposits. They're borrowing money from somebody else at one rate, and they're loaning it to you at a higher rate. And so the car companies have gotten huge into financing because they make more money on financing than they make on selling the car. And it's the same thing with the furniture stores that rent to own. They might borrow money at 5%, and they're loaning it to people at 12 and 15%. They make more money on the loan than they do selling the furniture or the car. And growing up, I had several friends whose families owned furniture companies, furniture stores, and they tried to explain this to me. But when you're 15, you don't understand it, okay? But they said, no, our store is not a furniture store. It's a bank. Like, what are you talking about? I go in there and I bought a dresser from you, okay? Yeah, but did you give us $500 for the dresser, or are you paying us $50 a month? If you're paying us $50 a month, we're charging you 15% interest. We're borrowing the money from the bank at 5%, and we're charging you 15%. We're making great on that deal. All right, finance companies. All right, life insurance, property casualty insurance companies. Again, these people are loaning money. When I was in corporate finance, we had connections with insurance companies, and we had connections with developers, real estate developers. And they would come to us, real estate developers would come to us and they'd say, we need $30 million to buy a piece of land and put an office building on it. And we can go to the bank, this is what the bank has offered us, but we know that you have institutional investors that will give us a much better deal than the bank. And we used to bring the two sides together and help them structure a loan. And we get a fee for doing it. Investment banking. It's a beautiful thing. as David Rose would say. All right. All right, now this is big, and we'll get into some of the details about the laws. That, you know, they repeat it too many times, but banking and finance in general are highly regulated, okay? Because they're very, very critical to an economy. You've got to have a good banking system to have a good economy, all right? So changes in the laws have allowed many different types of financial firms to offer one-stop shopping for services. So the laws have changed a lot in the last 30 years. You guys wouldn't know that because you're too young, okay? But 15 years from now, 20 years from now, you'll be talking to younger people and you'll say the same thing. You grew up at a time when things were really old-fashioned. And we had laws that really built walls around banking. All right. So there's a challenge to differentiate banks from the other financial service providers. They all look the same. Okay? Now this question is on the exam, and for some reason, the last 2 years, people have missed this question a lot. The phenomenon of companies offering very similar services is called convergence. Industries are converging. They're merging together and they're offering the same types of services. And it's called convergence. And there is a question that says, what do you call it when a large number of companies offer similar services? It's called convergence. Okay, don't miss that. That's a layup, man. Okay. Consolidation, the other C word, consolidation and convergence are related, but they are different. So there's a question about convergence and there's a question about consolidation. And I talked to you on Tuesday about consolidation. Okay? Consolidation is when firms merge so that there are fewer firms and the ones that survive are large. Okay? So consolidation is about economies of scale. Okay? It is about generating more revenue without increasing your expenses. Your expenses are held firm at one level, but your revenues explode. Okay? And it's economies of scale. And that is what consolidation is about. Okay? Why do you need 5 companies that do the same thing, and each company has a CEO, and each company has a CFO, and each company has internal auditors, and each company has their own info system, when you can combine those into one and have one info system and one high-paid CEO and one high-paid CFO, and the same, and have instead of 8 auditors, you have 10 auditors instead of having 40 auditors. That's economies of scale, and that's consolidation. That's what consolidation is. Convergence is when you go to Simmons Bank and you get a loan, you get a home loan, you get a car loan, you get life insurance, you buy a mutual fund. Okay, you're doing all of these things. That's convergence. When Simmons buys First Community Bank, that's consolidation. Know the difference? It's on the test. Don't miss either of those questions. All right. So this is what the industry looks like. Commercial banks have about 25% of all of the financial assets in the United States. Okay? At this time, this is old data. I got to get a new book. $14 trillion. Okay? Now the savings institutions, those are savings and loans. And it's lower today. Commercial bank assets higher, saving institutions lower. Okay? Then we have these non-deposit. Remember, to be a bank, you have to take in deposits. Okay? And you see that Fannie Mae and Freddie Mac are government agencies, and look at that, 22%. These are government agencies, and what they do is they buy home loans. Okay? That's what they do. They were created to make it easier for banks to loan to more people for home loans. The whole purpose, objective of creating these agencies was to help finance home ownership. Home ownership. Okay? It's that important. Okay? Why is home ownership so important? Stability. Stability. If people invest in a home, when you buy something, Ronald Reagan said it this way: you never see someone wash a rented car. Okay? So you go and you rent a Dodge Challenger, right? Or a Mustang, some muscle car, whatever it is, you rent it. And as soon as you pull out of the parking lot, what do you do? Particularly if you're a guy, what do you do? Ask you, what do you do when you get that Challenger? You know what I'm saying? Man, you punch it. You push it hard on the accelerator. Okay? But if you buy it and it's yours, you ain't gonna punch on the accelerator for 10,000 miles at least. And even then, you're gonna be a little careful about it. There's a little part of me that says, don't wear that engine out. You know. So, ownership is really important. All right. Investment companies, 12%. These are mutual funds. Okay? Small compared to the banks. Okay? Private pension funds, another source of institutional money, 9%. Life insurance companies, 8%. Look at all these. These are big financial institutions, and you have to combine them to get the assets that you have in banks. All right. Security brokers, 3%. It's tiny. These numbers were a little surprising to me. It shows you how dominant banks are. Now they're starting to give up some of those numbers. All right. So let's take a little history lesson and see what banks have done historically. All right, currency exchange. Banks have typically done currency exchange, and you can't have you're not going to do a whole lot of currency exchange with a community bank. You're going to need to go to either a regional, super regional, or a money center bank to exchange dollars for euros or yen. All right, making business and consumer loans. Okay. Now you know who a famous banker lender was that gets a lot of press during Christmas. Who was it? Who was it? You don't know who the Christmas lender was? Man, you don't know? Ebenezer Scrooge. He was a lender. Okay. All right. Savings deposits. It was important to have a safe place to take your money back in the day. Believe it or not. It was important. We don't think about it that way anymore. I mean, we got these cards. All of our money is on these cards. If we lose these cards, it's not a problem, because you'll get a phone call quickly and you dispute the charges. I mean, it's pretty hard to lose your money. When one of our trips that we made to Italy, I got pickpocketed. Anybody been to Italy? Been to Europe? Okay. So we were getting on the train and we were going, we were in Naples. Naples is notorious, man. Huge mafia presence in Naples. And we were going, I can't remember where we were going from Naples, where we were headed, but we'd been there, it was about halfway through the summer. And so it was me, Camille, Ben, and Lori. And a train pulled in, and we had our suitcases, and we were waiting on the platform, and the doors opened, and people kind of flooded out, you know how they do. And then this guy who looked like he was about 40 years old got off, and he looked at me, and he said, I'll help you with your luggage. I thought, that's weird. Been here 6 weeks, nobody's helped us with our luggage, you know. I had that thought, it's like, that's weird. I wasn't being suspicious, I just thought it was strange. So, he takes suitcases and puts them right there, you know, right in the entrance, lifts them off the platform into the train, and we get on, and he walks off. As the doors are closing, I'm wearing shorts, and I went, I don't know why, but all of a sudden I realized that my wallet was in my pocket, and he'd taken my wallet. So I got on the phone, and it took me about 10 minutes to get through to American Express. And in that 10 minutes, he spent $2,200. He went into, you know, he walked off the train, and in a lot of the train stations there, they have retailers in there. And so there was I walked through a couple of the trade cars, and there was an agent there, and I said, I've been robbed. And he went, what do you want me to do about it? You know, he was probably in on it. I'm sure he was in on it. But the beautiful thing was, they put a hold on the account immediately. They knew the retailers that he used, and some people got in trouble for that. And it didn't cost me a penny. Now, I had to reapply for a credit card and all that. It was inconvenient, and I was mad. And I was mad mostly because they did it in front of my kids. You know, like, man, how dare you do that? If I'm on my own, whatever, I'm mad that you did it in front of my kids. No. All right, but we don't have to safeguard. We don't have to safeguard our money anymore. Okay, safekeeping of valuables. Safety deposit boxes where you put your expensive jewelry and you keep your documents. You keep your wills and your trusts. Okay? So you give your spouse a key and you say, our safety deposit box is at Simmons Bank. And if I die, there is a list of every contact person, phone number, a listing of all of our assets, our insurance agent, the accountant, the attorney, everything you need to know if something happens to me. Safekeeping of valuables. They're fireproof, they're waterproof. All right, where you go to have appraisals done. What is something worth? What is an asset worth? Okay, banks have provided that service. Today there are independent people that will do appraisals. Okay? What's your asset worth? Okay? Banks throughout history have loaned money to finance war. War is big business, man. Okay? I mean, you know which country was critical to financing the American Revolution? Who was it? It was France. And they did it because they loved us. Is that why they did it? No. Why'd they do it? Because they hated the English, that's why. And they were competing. They were competing. And still today that's happening. Okay? You go into Africa, and in the last 15 years, China has invested trillions of dollars into Africa. Okay? They are competing